Business Roundtable is voicing its concerns over President Biden's proposed corporate tax rate. In a statement, the BRT president, Josh Bolten, said, "The administration's proposed global minimum corporate tax rate threatens to subject the United States to a major competitive disadvantage." Joining us now to talk about this and much more is former EY chairman and CEO Mark Weinberger. He served as the chairman of the Business Roundtable's Tax and Fiscal Policy Committee. And Mark, let me just ask you, Jeff Bezos is saying he's okay with higher corporate tax rates if that's what it takes to pay for infrastructure. Are you?
Well, Becky, the benefit that Jeff Bezos has is a company that is so dominant, it doesn't have to worry as much about global competition. But when you're competing around the world in markets, the relative effective tax rates matters a lot. A 28% rate, Becky, would be, when you add the state taxes onto it, over a 32 to 33% top rate. That is, again, amongst the highest in the world. It's certainly higher than any of our trading partners, OECD countries, G7. When we lowered our corporate rate back in 2017, there were some 10 other countries that followed us, and there's been a movement to lower rates over time, which has plateaued. No country followed us on putting in a global minimum tax. We are, as you just heard from the last speaker, there's no other country that has a taxation of domestic companies outside their borders. So now we're not only talking about having one that other countries don't, but doubling it to make it even less competitive in the vast majority of markets around the world.
Mark, what's the bigger problem here? Would it be raising the corporate rate to 28%? Would it be this GILTI plan that we were just talking about with global taxes? What do you see as the threat? Because I could understand why Jeff Bezos might suddenly come out and say it's okay to raise rates, corporate tax rates, if we're paying for infrastructure, but we need to be able, and part of what he said is all sides are going to have to give something in this. So maybe he's already looking to the idea that maybe you raise rates to 25%, which has been the sort of compromise that's been thrown out to this point, but hope to get something back with this global tax. How do you come down on this?
Well, yeah, Becky, honestly, it depends on what the structure and the makeup of your revenues and your company is. If you're a 100% domestic company, you care about the corporate tax rate in the United States. Increasingly, back in the 1960s, about 5% of our largest corporations' profit was overseas. 5 years ago, it was about 30%. It's probably more today. We have to compete in the fastest growing markets around the world. And so you're increasingly going to have to look at your relative competitiveness outside the United States. And that's where the GILTI tax or this global minimum tax comes in and makes us much less competitive in those markets. So, it really depends on how your company is structured and where you make your revenues to determine which one affects you more. Both are incredibly important. You can't ignore them. And Janet Yellen's right. I mean, if every country around the world increased their minimum tax or at least put one in, then maybe it wouldn't be a competitive disadvantage, but they don't have one. Talking about doubling ours when there's none elsewhere in the world is not the right way to do it. We should engage with the OECD on their project and do it multilaterally if that's what the broader business community and leaders around the world want to do.
Hey, Mark, you probably don't have a monitor, but I'm smiling. I just want to let you know that I'm smiling as I'm saying this. But when the Business Roundtable went all in on on throwing the Milton Friedman mantra out about shareholders and stakeholders and ESG and virtue signaling, God, you guys were really noble, and that was really virtuous. But now when it actually comes to actually doing something that might cost you money, whoa, hold on there. We like our statement, but you're not really going to do anything to us like this, are you? It kind of changes when something there's actual consequences to being so altruistic.
I'm happy you're smiling when you say that, Joe, because obviously the business community has been front and foremost, and you've criticized them for being a little woke in your words, I think.
Exactly. So now you get a chance to really be woke, but it's going to cost you something, so now you're pushing back. That's my point.
Well, no, the issue is corporations, when they get a tax increase, aren't going to take less vacations. They aren't going to go and eat less meals. They're going to have to either reduce the return to investors, reduce the amount of money they pay wage earners, lower jobs or lower wages, or not increase them as much, or reduce capital expenditures.
Well, there's consequences.
Those things that help the workers that the business community would have to give up.
Well, you should have thought about that back when talk is cheap, Mark. These are some of the consequences that come with being so woke. If you're going to be woke, you got to be woke. Wake up. Let's go, Mark. Let's get on board.
I'm happy you're smiling, Joe. I'm happy you're smiling.
I'm smiling. I'm smiling. Remember when it happened. You're right. I did criticize you. Now, okay. All right, good luck. We'll see. That's going to be
remember, you can't take care of your shareholders if you don't take care of your stakeholders.
I understand.
Shepard Smith here. Thanks for watching CNBC on YouTube.